Hello, everyone. I'm Dr. Ross DePinto. I'm one of your D366 course instructors. In this session today, we're going to be covering Section 2, Lesson 10.2, Short-Term Liquidity Risk. In your e-text, there is a reading that is available in Chapter 5 that covers the information we're going to be digging into in more detail in today's session, and it's in Chapter 5, pages 293 to 300. For our session today, we're going to discuss what short-term liquidity risk is. We'll identify factors affecting liquidity. We'll discuss how firms manage liquidity gaps. Then we're going to review some tools that we use for liquidity analysis, starting with common size current asset ratios, the current ratio, the quick ratio, our operating cash flow to current liabilities ratio, and turnover and days outstanding ratios. We will be presenting limitations, practical considerations, and worked examples for each of the ratios. And then we're going to present a worked example of a comprehensive liquidity analysis. So let's start by understanding what short-term liquidity risk is. And it is the ability for a firm to meet its near-term obligations to its suppliers, employees, creditors. It requires an understanding of the firm's operating cycle, meaning what are the cash inflows it can expect during the period versus the outflow timing. In most business practices, perfect timing of inflows and outflows is rare. There's always going to be some variability involved. And that's especially true for startups or growth firms. In startups, our cash flow is primarily coming from external resources because the firm is just ramping up. It's not generating a whole lot of net income from operations at that point, so it's depending on external financing. And the timing and availability of those funds can sometimes be very variable. When we have a mismatch in the timing of our cash inflows and cash outflows, that can lead to liquidity challenges, even for profitable firms. Some of the factors that are going to affect liquidity are rapid growth, where it increases our production costs before we get our sales cash inflows. So examples are when we have to invest in inventory, when we have fixed costs that we have to cover, when we have to cover our labor costs, and when a good portion of our sales that we're generating are coming in the form of accounts receivable on credit. Well, those accounts receivable do represent sales, but we haven't collected the cash on it yet, so it's not liquid at that point. When we don't collect enough revenues, we can experience operating losses, which are going to result in net cash outflows, such as those placements of funds for inventory, labor costs, fixed costs. In addition to those short-term liquidity factors, we also have long-term leverage items that can add additional pressure to liquidity. The first is our operating leverage, and that is the firm's dependence on fixed cost structures to generate its sales and profits. And our fixed costs have to be paid regardless of sales levels. They don't fluctuate directly with sales. That's going to be things like, let's say we produce printed t-shirts for local sports teams like high schools, colleges, professional sports teams. Well, let's say we're renting our warehouse and factory facility. Well, the landlord doesn't care how good or how poor our sales are. That rent that we've agreed to contractually, it's an obligation regardless of how our sales are. So as sales decline, that rent, that fixed cost is going to represent a higher percentage of revenue and therefore make less money available to cover other expenses and to have any money availability in net income as a form of operating revenue. The next is our financial leverage, and that is the firm's dependence on debt to generate sales and profits. So the interest expenses and the principal payments are going to require cash. But those also have to be paid regardless of how good or how poor our sales are. So these types of leverage items are going to add additional pressure to our short-term liquidity. When the firm operates, it has to generate enough cash to cover both operating and debt obligations. To manage liquidity gaps, firms that have healthy credit ratings are able to do so with short-term borrowing. They do use instruments like commercial paper, bank loans. They often maintain lines of credit that give them quick access to cash, and they have to disclose this in their financial statements. And an example that's presented in the e-text is the fact that Starbucks has a $750 million revolving credit line, and it also has $1 billion in commercial paper. Big firms can depend on these things. Smaller firms have to depend on more localized funding from local banks. They haven't really established themselves, so they're not going to be able to issue bonds. So it's maintaining relationships with their local financial vendors that is going to be important to keep them afloat. When they have these lines of credit, any untapped borrowing, meaning there's additional money available on the credit lines, that's going to give them the additional flexibility they need, but it also represents a potential risk if they max out those credit lines and can't meet those obligations on a regular basis. So there's some common tools we use to evaluate liquidity. Common-sized balance sheets are one of those tools. They provide a basic way for us to quantify the relative amounts of items that we've invested in based on assets versus liabilities. Now, for liquidity analysis, it's also appropriate to use a very specialized form of common-sized balance sheet statement, and that is going to be common-sized current asset analysis. So what that means is in a common-sized balance sheet, everything is portrayed as a percentage of total assets. Well, for liquidity analysis purposes, we're going to use just the current asset portion of the balance sheet. So all of our individual current asset accounts are going to be represented as a percentage of total current assets. So this is going to help us understand how those current assets are composed as far as their quality of liquidity, not just the quantitative amount of funds available for liquidity purposes. The other primary tool we use is going to be ratio analysis. And we have some key ratios that we will review here that will help us assess short-term liquidity risk. Our current ratio, our quick ratio, our operating cash to current liabilities ratio, our inventory turnover ratio, and then we have another series of turnover ratios that deal with just specific current assets. Our accounts receivable, our accounts payable deals with the liability side. Our cash turnover ratio just deals with our cash, and the total current asset ratio deals with all of our current assets. Let's start by talking about our common-size current asset ratios. So as mentioned, for this analysis, we're going to take each current asset account and express it as a percentage of total current assets. And that's going to help us understand how our most liquid assets are composed and their quality. And this is going to give us some better insights of how the firm can meet its short-term obligations. To perform this type of analysis, we're going to take each individual component of our current assets and divide it by the total current assets and multiply that by 100. And so we're going to get ratios like our cash and cash equivalents as a percentage of total current assets, our accounts receivable, our inventory, and our prepaid expenses. So each one of these ratios is going to tell us something very specific. And when we combine it with our traditional ratios, it's going to give us some information about the quality of our liquidity in addition to the quantity. So the first item we would look at is our cash and cash equivalents percentage. That's going to tell us what percentage of our most liquid assets are available as current assets. Higher percentages are going to mean higher immediate liquidity. The accounts receivable percentage is going to tell us how much the firm relies on collections from customers. High levels of accounts receivable means that we're reducing our liquidity, because these accounts typically, we want them to turn over in 30 days. But if they don't, then our ability to convert them into cash is going to slow down and decrease our immediate liquidity. The next is inventory, and that is the least liquid among our current assets. And a higher percentage of inventory is going to really slow us down in converting to cash, because inventory is associated with the specific products that we sell. Let's say I have that printed t-shirt company. Well, my inventory is typically going to consist of a lot of blank t-shirts and ink and things that go into the packaging of each t-shirt. Those things are very specific for that company, and therefore are going to be very difficult to convert into cash easily when we need it, unless we sell it to other firms that are in the same line of business. And then lastly, our prepaid expenses. Those really are not able to be converted into cash easily, and large percentages of those assets in our current assets also is going to weaken our liquidity. Any questions so far? Okay, no questions so far. We'll move forward then. So as we're using these current asset ratios, there are going to be some limitations into what information they can provide. So it's not an absolute liquidity measure. It shows us the composition, but not whether those assets can cover our liabilities, because we're only focusing on one side of the balance sheet. The next limitation, it doesn't show us the timing of those cash flows. The percentages just tell us what percentage of those current assets exist in that particular account. For example, our accounts receivable. We may say that our accounts receivable represents 40% of our total current assets, but that's not telling us with 100% certainty when we're going to be able to realize the cash from those accounts receivable. Okay, the next is it doesn't reflect the asset quality. So high receivables or inventory percentages does not really tell us what percentage of those assets are slow-moving or doubtful items. We go to our accounts receivable. We talk about those should be collected within 30 days. But we also know that most places like credit card companies or any firm that deals with a lot of its transactions in credit-based transactions, there's folks that do not pay on time. There's folks that let their accounts go 90 days, sometimes over 120, and a lot of times those folks default on their payments, and that creates a bad debt expense. So while we know the quantity of those specific current assets, we don't know how quickly we're going to be able to convert them to cash. Another limitation is our industry variability, meaning the way that our current assets is composed is going to differ depending on the industry we're in. And I'll give you an example. A place that's making large consumer goods, like an automotive company, they're going to have high levels of inventory. However, things like online software companies, where the company develops a software package and then it's available for folks to just download. Well, they don't have very high inventory levels. There's nothing physically they have to really stock. So their composition of current assets is going to be completely different because of the nature of that industry. And the last limitation is Anytime we're using ratios based on a balance sheet, it's a static snapshot. It tells us this is what the cash position looked like or liquidity position looked like at a specific point in time. It doesn't show us any trends or seasonality that may be occurring. Some practical considerations are we have to interpret the results of these ratios in context, meaning we should take a look at them, but combine them with other ratios to get a more complete picture. And this is going to be true with any ratios we use. We never really want to just focus on one ratio. We want to take a battery of ratios and see a much bigger picture before we make any business decisions. Another thing we want to do is benchmark, meaning we're going to take the results that we observe for the firm we are analyzing and compare it to the industry to see, does this firm seem to be having operations and liquidity that are normal or expected for that industry? We also want to see, are there any historical trends that we should be aware of this firm's liquidity versus the industry? Okay, the other thing we look at is quality assessment. So we want to look at, especially on our receivables, the aging and the inventory turnover. So as we said, for our accounts receivable, we expect things to be collected within 30 days, but we always look at what's called aging reports, and that is our 30, 60, 90, 120, and over 120, meaning there's going to be pools of our accounts receivable that fall into those collection categories, meaning some are going to be collected within 30 days. But then we have folks that don't pay. They roll over into what's called different aging categories. So if you haven't paid in 30 days, it then goes into the over 30, which is 30 to 60. And so we want to make sure that we're not letting a high percentage of our accounts receivable roll into those older aging groups, because that affects our immediate liquidity. Okay. The other thing to consider is complementary use. So it helps us take a look at these current assets to determine how reliant are we on things like accounts receivable, so that if we need to change collection policies, we can make some movement to do additional steps to convert those accounts receivable into cash much more efficiently. And it does require looking at things besides just the balance sheet. We have to look into the actual business operations and practices that are going to convert those accounts receivables into cash. And then lastly, we look at these for decision support purposes. And so as we're performing our credit analysis, we're looking at how we are turning over those accounts receivable, how we're turning over our inventory to determine, okay, what are acceptable credit terms we should offer to customers? What kind of credit terms should we be looking for as we are purchasing inventory, so that we can plan our internal liquidity much more effectively? So let's walk through an example of using common size current asset ratios. So in this specific example, we have a list of current assets here from firm A, and they have cash of 50,000, accounts receivable of 30,000, inventory of 20,000, and prepaid expenses of 10,000. So let's walk through how we would perform a common size current asset ratio analysis. So the first step is going to be to tally up the balances of all of our current assets, because that's the denominator we're going to need to calculate the value of each ratio. So when we take the sum of all those, we get 110,000. Next, we're going to state our formula for getting the component percentage of current assets, and then we will calculate each ratio. So our formula is the percent component of current assets is that component account's balance divided by total current assets, and then multiply by 100. So, for example, our cash, it has a balance of 50,000. We're going to divide that by the total current assets, which is 110,000. And that gives us 45.45. We can round that up to 45.5, which is multiplied by 100 is 45.5%. And we're going to follow that process for each one of our accounts. Then we can interpret the results because now we have a comparison of how much each account is represented in our current assets as a percentage. So what we see, fortunately, our cash represents the highest percentage of these current assets. So that tells us we have a pretty strong immediate liquidity position. Okay, we have accounts receivable of 27.3%. So how quickly we can convert that into actual cash is going to depend on our collection speed. Okay, our inventory represents 18.2%. Now we said that that is one of the least liquid assets, but fortunately, it is not a very high percentage of the total. And then lastly, our prepaid expenses, which is not really convertible to cash, and fortunately, that represents the lowest percentage of our total current assets. Any questions on conducting that form of analysis? Okay, if there's no questions, we'll move on to the next topic, which is the current ratio. And our formula for the current ratio is the current assets divided by current liabilities. This is going to indicate our ability to meet short-term obligations using our assets that are convertible to cash within 1 year. As we said, our expectation is that our accounts receivable, we should be able to convert them to cash within 30 days. Inventory, same thing. We want to be able to be turning over our inventory regularly. We don't want to hold high amounts. We want to turn it over into cash. So typically, we want to see a current ratio greater than 1. That's what lenders and suppliers typically look at, because what it means is that we at least have $1 in current assets to cover every dollar we hold in current liabilities. So historically, values of 2 and greater were considered very effective. But now, a lot of places have changed to just-in-time inventory. And so there's also the need to hold low levels of inventory. So that is going to impact whether we have a high current ratio. And one of the things I mentioned was the fact that when we have an industry like software, they don't have high levels of physical inventory. So that's going to impact whether or not that part of the current assets is going to affect the quick ratio. Okay, so we talked about historically the value of 2 being good or greater than 2. So the other thing to consider is that when we have equal changes to assets and liabilities, it's going to impact the overall value of our current ratio, depending on if the base value was less than 1 or greater than 1. Equal changes in the numerator and the denominator are going to have the same impact on the overall value of the ratio. Now, here are some caveats we also have to consider. Even though the current ratio may have a high value, it may not necessarily be a good thing. High values of this ratio may signal that there is some kind of poor economic condition happening. And here's a specific example. During a recession, inventory balances are going to build because companies are not selling their products due to declines in sales. And so that means that, okay, inventory is a current asset. This ratio is current assets divided by current liabilities. Well, if our inventory keeps building, well, the value of the current ratio is going to keep building. So even though it looks like it's a positive value, it's actually going to be a negative thing because it's due to poor economic conditions. Same thing if our accounts receivable are increasing in value because our customers are not paying their bills. Yeah, the current ratio is going to increase, but it also means that we are not turning those assets into cash. Okay, on the flip side of the coin, a low ratio can also indicate that we're actually efficient during growth phases. And the examples I point to is if we have rapid sales growth, we're going to be turning inventory over fast. So our inventory levels may be low, causing that current ratio value to decrease. Same thing if we're rapidly collecting our accounts receivable. If that accounts receivable balance remains low, yep, we're turning things over into cash, but we're probably going to be spending that cash to reinvest in the firm. So it's going to require a lot of additional digging to really understand what the value of your current ratio means in the context of the firm you are evaluating. Okay, and so firms with strong cash flows can operate with lower ratio values. As we said, if you're in rapid growth, it means you're turning over inventory and AR quickly. So your value for that ratio is probably going to be lower. And so you're going to want to, again, with any ratio, you don't look at it independently. You look at that value, but you also have to integrate it with other tools to get a bigger picture of what's actually going on, like looking at the operating cycle, looking at the cash flow, and then looking at non-current asset liquidity, such as our long-term liabilities, to see how is that being impacted as well. Okay, so there are some limitations to our current ratio. And you're going to hear this term window dressing used throughout this session and through the course. And it ties back to the whole notion of manipulation. And so just like firms can manage their earnings or manipulate earnings, they can also, to some extent, manage the values or manipulate the values of these ratios, such as timing purchases or timing the sale of assets before they actually report things. So they can delay purchasing inventory or supplies until after a reporting period date. They can accelerate the collection of receivables for specific purposes, or they can delay payments to suppliers. They can sell fixed assets just at the end of the period. And what happens? Well, we know from our cash flow statement, when we sell an asset, okay, that's going to impact our cash flow from investment. But that means that the asset value goes down, but when an asset value goes down on the balance sheet, cash goes up. So if we sell those assets, our cash account is going to increase, which is in our current assets. The other thing is manipulating the right side of the balance sheet, which will impact our current assets. So if we increase our short-term borrowing on our lines of credit that are in our long-term liabilities or even our short-term liabilities, that's going to increase cash, and that is going to impact the value of the current ratio. Okay, as we said with our percentage of current asset ratios, the current ratio is also not going to reflect cash flow timing. It is going to reflect a snapshot, and that's another part of this, another limitation. It represents, this is what it looks like as of this date, but it doesn't tell us a big picture of the timing of our inflows and outflows of cash. Okay. The current ratio, again, it's an aggregate. It's the total current assets, the total current liability. So it's not telling us the quality of those assets. That's why we have to use it in conjunction with other ratios in order to get a better picture of the asset quality we are experiencing. And also, as we mentioned, the current ratio, just like any ratio, it's not really a uniform, universal metric. We have to look at it in the context of the industry that the firm is operating in, because these benchmarks are going to vary between industries. And as I mentioned, retail firms are going to have more inventory as far as a value on their balance sheet than tech companies that are just selling cloud-based software downloads, right? So we have to take everything in its totality. We just can't focus on one ratio. Any questions on the current ratio before we move forward? No questions on the current ratio? Okay, folks, I'm going to be checking in with you regularly, so I just would appreciate if you gave me some feedback, because I don't want to leave anybody behind in the session. So if I ask if there's any questions, please make sure you chime in so I know it's okay to advance, okay? Thank you. All right, so some practical considerations of our current ratio is to use it for benchmarking purposes. Take a look at the firm's current ratio and compare it to other firms in the industry. Look at it year over year to see how it compares to the industry year over year. Now, despite its limitations, we do know that historically the current ratio does have some good predictive power. And so that's why it is used throughout the financial industry when we combine it with other ratios to use as a leading indicator of financial health or financial distress. Because it does have pretty solid predictive power, it's used in decision making. And again, we use it in conjunction with other ratios, other qualitative factors like credit history and cash flow trends, because remember, the current ratio is a snapshot. It doesn't show you anything moving over time, and it doesn't show us our actual cash flow. And then lastly, we have to interpret it in context, meaning we have to look at it in the context of the industry that the firm is operating in. So we have to combine it with other metrics like the quick ratio and other ratios for a more complete picture, especially when we're comparing firms within an industry. Because again, when we compare retail firms to tech firms, the ratio values are not going to align because it's a much different inventory model. So let's work through an example of the current ratio. So we have here a list of values. And so the first thing we want to do is state the formula and then identify the relevant information. So our current ratio is calculated by taking the current assets divided by current liabilities. So the first thing to do, identify our current assets. And out of this list, we have cash and cash equivalents, accounts receivable, inventory, and prepaid expenses. Well, this land parcel, yeah, it's an asset, but it's not a current asset. It is a long-term asset. So it will not be included in the total for our current assets. And when we add up those values, we get $150,000. The next is to tally up our current liabilities. So as we look at this list, the remaining items, well, accounts payable, that's a current liability, and accrued expenses. Net income, that is not a current liability. That is coming from the income statement, and if we're talking about balance sheet, well, that's eventually going to end up in the retained earnings section, which is in the equity section of the balance sheet. So it's not included in the calculation. So when we tally up those results, we're getting current liabilities totaling $100,000. We then apply the formula. So we have $150,000 divided by 100,000, which gives us a current ratio value of 1.5. and then we interpret it. So we have a value of 1.5. So that means the company has $1.50 in current assets for every dollar of current liabilities it holds. And as we said, generally speaking, a ratio that has a value above 1 indicates that the firm can cover its short-term obligations. But again, we have to look at the context of the industry that the firm is in to make sure that this is indeed a healthy value. Any questions? Okay. So the next ratio to talk about is a variation on the current ratio, and that is the quick ratio, also called the acid test ratio. And this is going to be a very specific form of the quick ratio. Now, in other courses you may have taken, you may have seen different formulas for this ratio. A common formula used for this ratio is total current assets minus inventory divided by current liabilities. Well, for this course, we're looking at a very specific form for this formula. We're only looking at the most liquid assets to calculate this quick ratio. And that means we're going to add up the cash and cash equivalents, the short-term investments, and the accounts receivable. And we're taking only that total and dividing it by current liabilities. So it's going to truly measure our ability to meet short-term obligations using assets that convert to cash quickly, and that is within 90 days. It's going to exclude all inventory and prepaid expenses because those are our least liquid current assets and take the longest to convert into cash. And it's going to provide a much stricter measure of liquidity than the current ratio. In general, a value of 1.0 or higher is considered healthy, but again, the value is going to determine on the industry. And our interpretation, if it's got a value of 1, it means that we have at least $1 of liquid assets to cover every dollar of current liabilities. So as you're going to hear this repeated throughout this session, you have to interpret these ratios in the context of the firm's placement in its industry, its operating cycle, its cash flow stability, and other factors. So as we talked about, industry variation is definitely going to matter when we have a value for this ratio. Okay, so capital-intensive industries, meaning heavy capital investments, things like manufacturing, utilities, they typically will operate at lower quick ratios because they're going to rely on inventory and long-term financing rather than short-term. Whereas with our service-based or tech firms, they're going to have higher quick ratios because, as we said, their inventory holdings are going to be lower. A firm that sells software with cloud downloads virtually has no inventory to speak of. So their quick ratio is going to look significantly different than a manufacturer's quick ratio. Now, we would expect that the quick ratio is going to be highly correlated with the current ratio, but this is going to show more pronounced changes because, again, we're dealing with only the most liquid assets in this ratio. So it tends to be more volatile. Okay, some limitations. Again, industry variability. It's going to matter where the firm is, which industry it is, that's going to drive what the norms are for that industry in terms of its most liquid assets. Again, this is a snapshot. It doesn't tell us the timing of the cash flows that are occurring. It's telling us this is the value at a point in time. But it's not telling us, because we're not including in the accounts receivable, how quickly we're going to convert those to cash and how quickly that cash is going to show up in the value of this ratio. Okay, it also excludes our inventory. but still includes some less liquid items. So some of these short-term investments, okay, we expect them we can convert them to cash in 90 days, but we have to be mindful of what the maturity dates actually are on things like CDs. If a CD is not going to mature for 90 days and we have a cash demand in 30 days, well, that's going to create a liquidity challenge. So we have to have a very acute awareness of what is actually going into those short-term investment accounts. Okay, as we said, this is not going to reflect operational efficiency. It's just taking a look at those most liquid assets at a specific point in time. It doesn't account for the stability or our ability to generate cash from our operations because we're not looking at the entire cash flow picture. And just like we said with our current ratio, this ratio is also susceptible to what we call window dressing, and that is manipulating the timing of payments and other transactions so that we can bolster the value of cash for specific purposes. The practical uses of the quick ratio, again, are for benchmarking. We're looking at it against other firms in our industry, looking at historical trends rather than relying on a single value for that ratio. We use it in decision making because it tells us our most liquid assets in terms of accessibility. And it also tells us that even though this, we're looking at our most liquid assets, we also have to take a look at the bigger picture to see the stability of that cash flow and other factors that are going to affect it. Okay, we can use it for predictive purposes. And one thing we have to consider is that even though inventory is not included in this ratio, the ability for us to turn over that inventory to convert it into cash is going to impact this ratio. And so we can't just use this ratio in isolation. We have to look at how our inventory policies, our accounts receivable collection policies have the potential to impact that quick ratio and its volatility. And as we said, we never look at a single ratio independently to make decisions. We're going to be using it with other measures in order to get a more complete picture for decision-making purposes. Okay, so let's do a worked example of this quick ratio. So again, we have these financial accounts and their balances reported for firm B. And so we want to calculate the quick ratio. So the first step is going to be to state the formula and then collect the relevant information. So the formula is cash and cash equivalents plus short-term investments plus accounts receivable divided by total current liabilities. So we're just going to pull out the current assets that are applicable here. So when we look at this list, okay, we have cash and cash equivalents. That goes into the ratio. We don't have any short-term investments. So that value is going to be 0. And it looks like I have a typo here. Yes, I have a typo here. This should be 100,000, not 70,000. So I'll make sure I correct that and get that. You know what? Let's just, yeah, I'll correct this slide and get an update to you folks. But yeah, this should be 100,000. Okay, and so the only two current assets that are included in this ratio are going to be our cash and cash equivalents and accounts receivable. So that's going to be 100,000. There's no short-term investment, so that's 0. And our accounts receivable is 30,000. So that gives us a total of 130,000 for the numerator. Okay, we go to our current liabilities. So the only things we're going to include here are our accounts payable of 70,000 and our accrued expenses of 30,000. The other two items included in this list, the land parcel, that's a long-term asset. The net income, again, that's going to go into the equity section into retained earnings. So these are the only values that are relevant for this ratio. So we apply the formula, which is going to be 130,000 divided by 100,000 to give us a quick ratio value of 1.3. And so now that we have the value, let's interpret it. So we have 1.3. So that means this firm has $1.30 in quick assets for every dollar of current liabilities it holds. And we said a general rule of thumb, general guideline is that a ratio above 1 suggests a healthy short-term liquidity because the firm can cover its immediate obligations without relying on inventory sales. Because remember, inventory is not included. Accounts receivable isn't included. So this is actual cash and cash equivalents that we can use to meet obligations. And so, as we stated, even though this looks like a good value, we have to take the industry context into consideration. If we have a service or tech firm, this is typical, but if we have a manufacturing company, this is going to be considered really strong because we know this is taking out the impact of inventory. Any questions on the quick ratio? Okay. The next is a little bit different ratio. This is the operating cash flow to current liabilities ratio. So we're actually going to be using a value that's coming off of the cash flow statement rather than the balance sheet or the income statement. And what we're going to do for this ratio is take our cash flow from operations divided by our average current liabilities. Excuse me. So this is going to measure the cash generated from operations during a period relative to current liabilities within a year. And so this formula uses our cash flow from operations for the period we're evaluating, typically a year, but we can do it on a month-to-month basis if needed. And we're going to divide that by the current average liabilities for that period. And this is going to indicate the firm's ability to meet its short-term obligations if it uses its operating cash flows rather than just balance sheet assets. So some of the limitations we experience here are timing differences. Because remember, if we're using cash flow from operations, this uses accruals, not just cash. So again, the current liabilities are at a point in time. So it's going to be different. And so this can distort the value and meaning of this ratio. The other thing we have to consider is seasonality and volatility. So if we have a very seasonal business, like anything that's reliant on the holidays, like Christmas trees, for example, or even retailers, a lot of retailers depend very heavily on the holiday periods. So it's going to show strong results for this ratio in peak periods and weak values in off periods. So this can make the interpretation really tricky for any type of industry that is purely seasonal. Another thing to consider, it's going to ignore our non-operating cash needs. So it just focuses on our cash flow from operations. It doesn't focus on cash flow from investing or cash flow from financing activities. With any ratio, it's going to vary by industry. So there's no universally accepted value for this ratio. The ratio is not going to capture our liquidity reserves. So it doesn't show us any cash reserves that are still liquid because we're dealing with just the cash flow from operations. And so we might have other liquidity that we can tap that's not reflected here. Okay? And then it's susceptible to accounting choices because, again, you can manage your working capital. You can choose to make inventory purchases based on timing. So that is going to affect the value of this ratio because changes in working capital accounts impact our cash flow from operations. Practical considerations of this ratio are that it can be an early warning signal. A low value for this ratio may indicate potential liquidity stress, and that may cause the firm to seek additional credit lines or adjust its operations. Because remember, the numerator here is the cash flow from operations. The primary driver of cash flow from operations is our net income. So if net income is not good, that means the cash flow from operations is typically not going to be good. And if you have increases in working capital accounts like inventory, accounts receivable, that's going to really put a strain on your liquidity. So looking at this ratio gives us an indication if other measures need to be taken from an operational perspective. Okay. It's also used as part of a firm's credit assessment, and lenders will look at this ratio to see how effectively firms can repay their loans from their operating cash flows rather than liquidating assets. Remember, even though we're looking at cash flow from operations, the cash we generate from our operations is used to service long-term debt. A piece of what we bring in every period has to go toward paying off long-term liabilities like bank loans. If we're talking about large corporations who've issued bonds, well, the cash they generate has to go into paying off bondholders when bonds mature. They have to pay off the face value of the bonds, which is typically going to be a balloon payment. You know, if you have, let's say, you issued $20 million of bonds that mature in 5 years. Well, when the 5 years is up, you've got this balloon payment in your long-term liabilities of $20 million that has to go out the door. If you can't generate the cash from your operations to pay that off, it's going to definitely affect your credit rating. Okay, and next, this is a good indicator of operational efficiency. If this ratio is consistently strong, it means that our cash flow from operations is consistently strong, because the biggest component of it is going to be our net income, hopefully. And it typically means we are in either a very solid or growing period of the firm's life cycle. And it's going to really impact our ability to take that cash flow to pay our current liabilities and lower that ratio. Then lastly, as we said, you can't use any one ratio in a vacuum. You have to look at it, but then compare it with other ratios and the bigger picture of what's going on with cash flow in order to see the complete liquidity picture for the firm. Okay, so let's go through an example of calculating this ratio. So here we have some information from Firm A, and we've got different values here. And so we want to compute the firm's operating cash flow to current liabilities ratio. So the first step we're going to do is calculate the average current liabilities. That's the denominator for this formula. And so to calculate the average, we take the beginning balance plus the ending balance divided by 2. So that is going to give us a value in the denominator for average current liabilities of $330,000. The next thing we're going to do is apply the actual formula, which is the cash flow from operations divided by the average current liabilities. Now, what we have to consider here is that the cash flow from operations already includes the depreciation added back. So we're not going to add back depreciation again. It's already included in this net value. So we simply take our operating cash flow, which is $120,000, divided by the average current liabilities, and we get a value of 0.36. Okay, so what this is telling us is that the company generated cash flows that equal 36% of its average current liabilities during the period. And so an average for this ratio or a benchmark is typically 0.4. And again, it's going to vary depending on the firm you're in. If you're in a retail or a manufacturing firm, you're going to be looking at a value of 0.4. If this firm A, was a retail or manufacturing firm. This value of 0.36 is slightly below that benchmark. So it means that we have to look to see additional information to determine if we have a real liquidity problem here. So it could be that we need to look at improving our cash flow from operations, meaning improving our collections policies, getting a better handle on our inventory management. And it also means that we may need to access lines of credit to bridge any liquidity gaps. Any questions on this ratio? Okay, so the next set of ratios we deal with are interrelated. And those are working capital turnover ratios and the number of days outstanding. So in general, our turnover ratios answer the question, how many times per year? So it's going to depend on the ratio. So if it's the inventory turnover ratio, the answer is going to be how many times per year are we turning over our inventory? So it measures the rate of activity in our working capital accounts. How many times the account is cycled through during a period, typically a year. And it assesses the ability for that particular part of the operation to generate cash. If it's inventory turnover ratio, it's how well are we converting our inventory into sales, which generate cash. If it's accounts receivable, how efficiently are we collecting those accounts receivable to turn them into cash? So the interpretation is going to be a higher turnover value means faster conversion. For inventory, it means we're selling it more quickly. For receivables, it means we're collecting them faster. And so this helps us further evaluate our liquidity risk beyond just our static ratios like the current ratio and the quick ratio. Now, on the other side of that, we have our days outstanding ratios, and that tells us specifically how many days does it take. So we're taking our turnover ratios and turning it into a time measurement in days. So the general formula is going to be we're going to take our turnover ratio and we're going to divide it into 365. So when we do that, it's going to tell us the number of days it takes us to convert inventory, the number of days it takes to collect accounts receivable. And so the general rule is that the lower the number of days, the faster the cycle, meaning we're getting cash generated quickly from that particular part of our current assets. A higher value means it's slower to convert that particular asset into cash. And so the thing to remember is that these two ratios are inversely related. If you have a high turnover ratio, you have a low number of days outstanding. That means it's efficient. If you have a low turnover ratio, it means you have a high number of days outstanding, which means it's inefficient. And so I've listed out the different formulas that we would use for our working capital turnover ratios and those days outstanding. And they're very similar as far as how you can compute them. We're always going to use averages in the denominator, which means you take the beginning balance plus the ending balance divided by 2. For inventory, we do have to consider a few more calculations because sometimes we have to deal with purchases and cost of goods sold. And that's going to impact how many steps we have in calculating these turnover and days outstanding ratios. So here are some limitations in using these ratios. And so for turnover ratios, it's going to vary by industry. Some inventory turns over much higher than others. Okay, when you're talking about things like heavy machinery, you have a much lower turnover ratio than you do with things like groceries. So you have to consider the industry that you're evaluating. Okay, seasonality, it's going to impact the value of these turnover ratios. You know, when you look at, the upcoming holiday season, right? Things like groceries. We're probably going to have higher turnover ratios there. When we look at retailers that sell toys, well, you're probably going to see a real high turnover ratio in the fourth quarter compared to the rest of the year. So you have seasonal factors. The other thing is these ratios don't reflect profitability. Okay, just because you're turning over inventory doesn't mean you're necessarily profitable. And the example I give you is when we have industries where the markup is very low, like groceries. There's very low margin on all grocery items. So even though you are experiencing high levels of turnover, that doesn't necessarily mean you're expanding your profitability. Okay, another thing we have to look at is, again, distortion because of accounting choices. And we talk about different inventory methods. Well, if you're using LIFO versus FIFO, that's going to impact the cost valuation you're using on that inventory, and that can distort your turnover. Okay, again, with all ratios, we want to look at a battery of ratios and look at trends. We don't want to look at just a single value at a single point in time. Looking at the trends gives us a much bigger and more valuable picture of what's actually happening. Okay, for our days outstanding, remember, these are the inverse of our turnover ratio. Okay, it tells us in days how quickly these assets are turning over into cash, but it doesn't necessarily tell us any of the other underpinnings and doesn't solve any of those limitations. Okay, this days outstanding, okay, it's also assuming that things happen in a uniform way, because we're only taking the number 365, which is the total days in the year, and then dividing our turnover ratio into it. It doesn't take into account, as we said, very seasonal things like toys. It doesn't tell us, well, what percentage of this turnover actually happened in the peak seasonal season. You may have to do some additional digging and just frame those ratios in the context of that time period and look at it season to season. You might want to break up your turnover into quarters rather than looking at an annual figure. Okay, the next, it doesn't capture our collection quality. So, for example, when we do our accounts receivable turnover, it's really not telling us what's happening with our bad debt. It's not telling us what's happening with our accounts that are taking over 120 days to collect. It's just giving us a big picture. So again, sometimes you have to decompose these ratios in order for them to be more effective indicators of what's happening. Okay, as we said in other ratios, industry matters. What's acceptable in one industry may not be acceptable in another. And again, we look at retail versus manufacturing. We look at those software companies. The software companies, well, they have very little inventory, so it's going to be very difficult to make any type of comparison. And then lastly, this is a static measure. It reflects our past performance, but it really doesn't tell us what's happening in the future and doesn't tell us how efficiently we are actually operating. It's just a snapshot at a point in time. So what we can use these ratios for is, again, benchmarking, looking at our values of a firm compared to industry norms and historical trends. Okay, we can look at it for efficiency if we take it in the right context. High turnover means efficient operations in inventory receivables. So we can use those metrics in that context, but we have to be aware if we're dealing with seasonality. In general, we can use them to assess liquidity. We know that faster turnover improves cash flow, and that's going to reduce our liquidity risks. So we do want to see that we are experiencing efficiency in turning over these less liquid assets into cash. And then we also want to make sure, again, we don't use one ratio in a vacuum. We want to combine it with other measures of profitability and cash flow to get a bigger picture of what's actually happening. Same thing with our days outstanding, okay? Lower days outstanding indicates faster cycles. So for things like, food items, we do want to see a number of days outstanding very low, because if we see high values, it typically means we're throwing out a lot of items, and especially when we're dealing with produce. You want the number of days outstanding to be very low. But again, it's going to depend on the industry. We look at, groceries compared to automobiles. You're going to see things very differently as far as inventory turnover and number of days. Okay, these ratios can help us significantly in cash flow planning because it helps us time when we're going to have inflows and outflows for working capital purposes. That number of days outstanding on our inventory, it's going to let us know how frequently we need to order inventory. And so it tells us, okay, when do we need to have cash reserves on hand so we can place those orders and pay the vendors? Okay, the next thing it's going to affect is our credit policies. So if we're seeing that we have a high number of days in turning over our receivables, it probably means we have to take on more stringent underwriting policies for actually offering credit to make sure that any accounts that we take on as receivables, they're creditworthy. And then also that we are putting policies in place that really are stringent in collecting our cash within 30 days and making sure we don't let accounts sit there for more than 30 days because it represents cash that we can't use for other purposes. Okay, our payables days is going to also influence our relationships with our vendors. And so while we want to pay our bills as late as possible so that we hold that cash, we have to make sure we're not putting our credibility at risk with our vendors, that we are holding on to cash as much as we can, but making sure the vendors are paid within the specified time periods they require. And then lastly, we're going to take a look at these days outstanding with our turnover to make sure we've got a clear picture of what is happening from an efficiency perspective. So let's do an example here where we are taking a look at turnover and days outstanding. So we have Firm C. It's a startup company in the retail, fashion, and apparel industry. And we have some industry benchmarks that we can compare the performance against. So for inventory turnover, they expect to see a value of 6 to 12 times per year. For our inventory days outstanding, you only want to see the inventory sitting there from 30 to 61 days, or 1 to 2 months. So Firm C has reported this information we see on the screen. We have a cost of goods sold of 100,000, beginning inventory of 40,000, purchases of 80,000, sales of 300,000, accounts receivable of 75, and accounts payable of 50,000. So we want to know how long inventory was held before it was sold. And so we assume 365 days in the year. So we're going to have to know two things. How long was inventory held before it was sold? So we need to know the turnover ratio, and then we have to know the number of inventory days outstanding. So let's start by writing out the formulas we need. So to get the inventory turnover ratio, it's cost of goods sold divided by our average inventories. So our average inventory is beginning inventory plus ending inventory divided by 2. Now, we don't have an ending inventory value explicitly stated, so we're going to have to calculate it. To calculate our ending inventory, we're going to take our beginning inventory plus purchases minus cost of goods sold. Okay, so that's going to give us the values that go into the turnover ratio. Once we have the turnover ratio, we can calculate the number of inventory days outstanding by taking 365 and then dividing it by our inventory turnover ratio. So the next step is we're going to take the values we have available and calculate our ending inventory. So our ending inventory is going to be our beginning inventory of 40,000 plus our purchases of 80,000 minus our cost of goods sold of 100,000, which gives us a value of 20,000. Now that we have the ending inventory, we can calculate the average inventory, which is the beginning inventory plus the ending divided by 2. So we take that beginning value of 40,000, ending value of 20,000. That gives us 60,000. Divided by 2 gives us an average inventory value of $30,000. Now that we have the two components we need for this ratio, we perform our inventory turnover calculation. So we're going to take our cost of goods sold divided by average inventory. So that's going to be our cost of goods sold of 100,000 divided by our average inventory of 30,000. So that gives us a ratio of 3.33. That means our inventory is turning over about 1 1/3 times per year, about a little bit over 3 times per year. So if we convert that now into the number of days outstanding, we take 365 divided by the inventory turnover ratio. So that's 365 divided by 3.33, which gives us a value of 109.5 or about 110 days, which is about 3 months. So now to interpret these results. So firm C is holding inventory 180% to 370% higher than other firms in the industry. Excuse me. What did we say? We said that firms in this industry are only holding inventory about 30 to 61 days. Firm C, they're holding their inventory for about 110 days. So this is an indicator that there needs to be some operational and policy changes to be more efficient. And so some of the things we can recommend is looking at its purchasing and procurement policies to make sure they're not buying too much inventory or making sure they're buying the right inventory at the right time. And then also making sure that they have the right promotion and market and sales strategies in place to improve operational efficiencies. Any questions on this? And again, this is one of the longer calculations, but the thing to keep in mind is to organize the information, and it follows a logical flow. And it's just keeping the information organized, making sure you're identifying the key pieces at each step. So the next thing we want to take a look at is a more comprehensive liquidity analysis. So we're going to combine the techniques we've presented here. So we're going to first do some common size current asset ratio analysis to look at the structure and quality of the current assets. Then we'll take a look at the current and quick ratios to see our quantitative coverage of liabilities, our current liabilities. And then we'll look at our turnover ratios to look at the efficiency in which the assets are being converted into cash. So we have this example here where we have two firms we are comparing. And I believe I posted the slideshow in the section of the WebEx meeting room for resources. So you can download it. I will send you an update because that one typo we found on the slide. But this is the complete set of data that we're going to use for this analysis. So what you'll see here is we have some detailed information about our current assets, and then we have our total current assets. We have our current liabilities. We're given our cost of goods sold, the sales, the purchases that happened for our inventory purposes, our average accounts receivable, our average inventory, and our average payables. So from there, let's perform a little bit more comprehensive review of the firm's liquidity. So the first thing we do is we're going to take the firm's current assets for each firm, and we're going to do some, common size current asset ratios. So that's going to measure the structure and quality of the current assets. So even though firm A and firm B both have total current assets of $1 million, we can see that the composition is different. And that when we do this analysis, firm A has more near liquid assets. You know, their cash and cash equivalents is 15% of their total current assets. Firm B only has 5%. Okay. However, firm A is also going to have, less inventory than firm B. So again, this is another indicator that firm B has slower liquidity because more of its current assets are tied up in inventory, which is not a liquid asset. And then we both see that both firms here have prepaid expenses representing 10%. So they're the same there. But the insight we can draw just from this here is that firm A's asset composition is more liquid. 45% of it is in cash and cash receivables as compared to firm B. See, because we have 15 plus 30%. And then for firm B, it's 5 and 25%. Any questions on that part of the analysis? Okay, next we take a look at their current ratio and the quick ratio. So firm A and firm B both have the same value for their current ratio. They both have $1 million in current assets and $600,000 in current liabilities. So they both have a current ratio value of 1.67. So they equally have the capacity to cover their liabilities with $1.67 in current assets available for every dollar in current liabilities. However, when we drill down into the quick ratio, this is where we're seeing the difference. Okay, firm A has our cash and accounts receivable of a total of $450,000 divided by $600,000, giving them a quick ratio of 0.75, whereas firm B only has a quick ratio of 0.5. So even though both firms show the same current ratio, firm A's quick ratio shows us it can meet 75% of its short-term obligations with highly liquid assets, meaning it has 75 cents for every in completely liquid assets for every dollar of current liabilities it holds. Firm B only has 50 cents in liquid assets for every dollar of current liabilities. So firm A has a much more solid liquidity position and it's higher quality. Any questions on that part of the analysis? Okay, so next thing we look at is the turnover ratios. So we've got 3 turnover ratios we calculated: the inventory turnover, the receivable turnover, and the payables turnover. So when we look at the inventory turnover, firm A is turning over inventory 6 times a year. Firm B only 4 times a year. So firm A is converting its inventory faster. So that means it's freeing up cash sooner, generating the cash from inventory quicker. Okay, next is our receivables turnover. So firm A is turning over its receivable 10 times a year. Firm B is turning it over slightly faster, 11.2 times a year. So that means it's increasing its liquidity faster. So the thing to keep in mind is, remember, our receivables are typically on a 30-day cycle. So we want to see a value of about 12 here, meaning we are turning over our accounts receivable 12 times a year. Well, it means that firm A is a little bit lagging behind, but firm B is almost there. So they probably have less accounts rolling over to the over 30 category. Okay, next, our accounts payable, and that's our purchases divided by our average accounts payable. So firm A is only turning over their payables 8.7 times a year, whereas firm B is turning over 12.5 times a year. So that means firm A is taking longer to pay its suppliers and conserving cash. But they also need to look at it to make sure that they're not putting any vendor relationships in peril. Okay. So to summarize the insights here, firm A is efficiently turning over its inventory, and it has a major liquidity advantage here because it's turning it over faster, converting into cash. Firm B is collecting receivables a little faster, but this is offset by the fact that they're not able to convert the inventory into cash because that's their slowest moving current asset. And that's going to put a strain on liquidity. Okay, so firm A is managing its payables effectively. And this shouldn't harm their relationships with their vendors, but they should check in just to make sure there is nothing that's not being paid on a timely basis. Any questions on this part of the analysis? Okay, so that concludes the actual part of this session where we're going through the materials and how to apply them. So what I've prepared for you here is a list of reflective review questions. So as you're going through the material in this lesson, make sure you can address these questions because this is going to help you prepare for what you're going to be expected to do on the OA. And so let's summarize what we've gone through in this session. Okay, so short-term liquidity risk is the ability to meet near-term obligations and is going to be influenced by the timing of our cash inflows and outflows. And this is especially important when we talk about things like inventory and accounts receivable. Some of the factors affecting our liquidity are going to be rapid growth, operating losses, operating leverage, which is our dependence on fixed costs, and financial leverage, which is our dependence on debt to generate profits and revenues. Next, we talked about managing our liquidity gaps. And to do that, we're going to manage our short-term borrowing, maintain lines of credit that we can tie into when we need cash, and leverage untapped borrowing capacity when needed. We've gone through several forms of liquidity analysis tools. We used common size current asset ratios to show the composition and quality of our current assets. We went through the current ratio, which indicates our ability to cover our short-term obligations with just current assets. We've reviewed the quick ratio, which measures our liquidity using only our most liquid assets, which is not going to include our inventory or our prepaid items. We've looked at the operating cash flow to current liabilities ratio, and that assesses our ability to meet our obligations from operating cash flows. And then lastly, we looked at turnover and days outstanding ratios. So that's going to evaluate the efficiency of converting things like inventory and receivables into cash. And then lastly, we have to remember that all ratios are going to have limitations as far as timing, asset quality, the industry variability that we are going to observe. And we have to interpret these values when we receive them in the context of the industry and the firm, but then we also have to benchmark it to norms that are inherent to that industry in order to have a valuable evaluation. Any other questions before we conclude the session? I'm not sure I understand it. Okay, Zach, you've just typed in ratios. I'm not sure what context that means. Can you elaborate on that? Okay, you downloaded the page and ratio. Okay, so the question is, do you need to learn the ratios? And the answer is yes, because if you take a look at the quizzes, you take a look at the pre-assessment, you're going to see there's lots of ratios mentioned. And again, the questions coming from the OA are a question bank of hundreds of questions. So you really don't know what ratios you're going to be asked. So it's a best practice to learn those ratios. And the thing to keep in mind is you have to use the versions that are presented in the e-text. And that's what we've consolidated for you on that ratio sheet. Because, for example, there are versions of the quick ratio that are different in this course than other courses. There are versions of the return on assets ratio that are very simple. But when you look at the return on assets ratio for this course, it's far more detailed. And so you have to use the formulas that are presented in this course. Any other questions? Okay, so if there's no questions about the presentation content we went through today, let's walk through some review questions to see how you're tracking on what we've learned today. So first question here, what does short-term liquidity risk refer to? And you can just type your answer into the chat. Okay, and the answer is B. It's going to be our ability to meet our near-term obligations, paying our suppliers, employees, and creditors soon. Okay, which of the following is not a risk factor that affects liquidity? Okay, well, the answer is going to be C. High inventory turnover improves our liquidity. It's not a risk factor, right? If we have low inventory turnover, that is going to be a risk to our liquidity. But if the inventory turnover is high, it means we are converting our inventory to cash efficiently, and that is going to improve our liquidity. Okay. Which assets are excluded from the quick ratio? Okay, and the answer here is B, inventory and prepaid expenses. The quick ratio is going to exclude our least liquid current asset items. Okay, so we have a quick ratio of 1.3. What does that mean given the four options we have presented here? And the answer is A. We have $1.30 in quick assets for every dollar we have in current liabilities. So that indicates a pretty strong liquidity position. Okay, so the next is common size current asset ratios express, and which one of the following would be the correct answer? Okay, the answer is going to be B. Each component as a percentage of total current assets. It shows the composition of our liquidity. Okay, then we have the operating cash flow to current liabilities ratio measures, and which one of these is it going to measure? Okay, and the answer here is going to be B, the cash generated from operations relative to our current liabilities, and it focuses on our operating cash flows. So which one of these ratios is most used for assessing liquidity quality rather than quantity? Okay, so the answer here is our common size current asset ratios. So it focuses on our liquidity quality, the composition of our current assets. Because remember, our current assets is an aggregate number, but it includes assets that are not easily converted to cash, like our inventory and our prepaid expenses. If we perform this common size current asset ratio analysis, it's going to tell us what percentage of our current assets is available in cash and cash equivalents and our accounts receivable, which are our most liquid assets. So it's going to tell us the quality of the liquidity. Okay, which of the following is a practical consideration for turnover ratios? Okay, the answer here is going to be A, benchmarking them against industry norms. And that's essential for getting a meaningful interpretation. You can't do anything in a vacuum. Okay, which of the following items here is a limitation of the current ratio? Okay, and the answer here is going to be D. All of these items are going to be limitations of using the current ratio. It ignores timing of cash flows, the asset quality, and it can be manipulated or subject to window dressing is what we say. Okay, our days outstanding ratios are calculated by which of the following general formulas? Okay, and the answer here is going to be B. And so anything that is a days outstanding ratio is going to be 365 divided by the turnover ratio that we are using. Okay, which of these ratios is most affected by aggressive collection policies? And the answer here is going to be C, the accounts receivable turnover. Aggressive collection policies are going to speed up our turnover, or how quickly we are converting these receivables into cash. And that concludes the review questions we have for you today. If you need help in the course, make sure you're taking a look at the course community discussion group and the course resources page. There's all kinds of resources that are now available. There are regular posts to the discussion thread that will keep you informed of any new resources available, when live events are going to happen, and general tips about navigating the course. Make sure you're using course instructor appointments to navigate any questions that you have about the course. That is the most efficient and effective way to address anything that you need to know. And you can use the Meet Your Instructors section that is posted in your community discussion. Excuse me, in the course of community, there's a tile, I should say, that is Meet Your Instructors and on the course resources page. Okay, the question that's posted here is, when will the video be available and where can I get it? All videos have to be edited to make sure that the closed captions are accurate. So most likely you'll see this video available tomorrow. And we always post the videos in the course resources page in the live events, the course cohort resource section. And typically we post an announcement in the discussions thread, and you typically get an email telling you when new resources are available. Okay. Make sure you're also attending live cohorts like this. We've changed the cadence, and there's going to be typically there's going to be a live event every Sunday. The only exception may be Thanksgiving weekend, because we know folks will be spending time with family. But we also plan to expand to hopefully at least 2 sessions a week. So just keep an eye out on your Explore Live cohort offerings link. There'll be some updates there. And then you can always email your assigned course instructor or send a message to the team mailbox. And if you have a onesie twosie type question, we always take a look at those, and that's an efficient way to get those quick answers when you need them. And we thank you for your participation today. Hope you have a great rest of your day. Take care.